Hi, I'm Dave Brickell, Director of Sales at Paradigm. Welcome to The Big Picture.
Vol is reverting, so the obvious trade is always the expensive one to
this
carry.
whole peak inflation, peak rates narrative, peak Fed, which we've been talking about.
It's an expensive place to find out. Crypto vol, a potentially fatal place to find out.
The crypto option markets are definitely showing some signs of life. Hi guys, welcome to The Big Picture. My name is Joe Cruey. I'm at Paradigm in the weeds around everything crypto vol markets. I'm joined here by macro man David Brickell, as well as Clara, who leads research at Kaiko. Honestly, guys, they truly have some of the best research out there on crypto market microstructure, liquidity. So definitely check out their website, check out their research. We'll link it in the description below. We're going to have a massive episode today, but before we begin, smash that like button, smash that subscribe button. We're here every week to give you the latest and greatest around crypto derivatives, markets, and beyond. Clara, thanks so much for coming on. To begin, if you could quickly introduce yourself to our viewers, give a brief overview of your background, how you ended up in crypto and what you're doing at Kaiko.
Yeah, for sure. Thank you guys for having me. So I'm Clara. I'm the director of research at Kaiko, and I've actually been here for 5 years, which of course is ancient in the crypto world. But I started getting interested in crypto back in 2017, so not that early, about the first wave of bull market interest. And then I moved to Paris to work at Kaiko. Kaiko is a French headquartered company. We're a crypto data provider, but we do have global offices. We have a big presence in New York, in Singapore, and in London.
Awesome. Well, again, really glad to have you on. And as I said earlier, I honestly think it's some of the best research out there. And I think it's timely that we're having you on. It's certainly been a massive couple of weeks in terms of news flow in the crypto space. Some obviously not so good with, the SEC complaints against, Coinbase and Binance, but also some really good news around, the BlackRock's BTC ETF application that, we really think has been the main driver of the Bitcoin price action, through the top of this descending channel, that I have on this chart. And, perhaps now we're finally kind of seeing that catalyst that's going to kind of take us to fill the gap back towards that 30K level and on obviously, hopefully beyond. But, floors on Paradigm have really kicked up in a big way here, right? We're seeing a lot more people coming back and re-engaging the crypto option market, praying for these upside moves. And that's especially occurring in Bitcoin, having been in the doldrums. Spot has been pretty range bound. It's kind of, consolidated and just grinded lower for a little bit. And finally starting to see again this resurgence of upside interest on Paradigm. And, I don't want to say that it's akin to, Q1 of this year when we had the very blistering spot rally, but it's nice to finally see some of this Bitcoin flow return as Bitcoin returns into the spot up, vol up environment as we break out of this channel. So just looking at some of the prints from the past few days, obviously the very big one has been, just these 40,000 calls. And at the time of recording, literally as we were jumping on, there was more size going up in this outright call right before we actually hit the record button today being Wednesday. But also, the June 27K call being bought, the August 36K, and then also a bunch of call spreads, the June 33, 36, 33, 35s as well. So kind of playing for that short-term sort of upside move. And, notably, a lot of the buyers, of these prints have been a lot of natural taker interests that are coming back and really re-engaging the market for the first time in months, really since Q1 of this year. In the action, at least on Paradigm in the crypto options market, has really concentrated in Bitcoin, rather than Ethereum, which I think it makes sense given like the iShares narrative at play, as well as, Bitcoin's relative insulation, from regulatory action. I mean, I feel at this point, Bitcoin feels pretty bulletproof. So, Clara, I would really like to hear your perspective on the iShare news. Do you think it potentially leads to this Bitcoin versus ETH outperformance? Which is certainly what we've been seeing in the crypto options market.
Well, I think we actually just looked at sort of Bitcoin dominance, and specifically on US exchanges, we saw that Bitcoin's dominance has increased from 29% of spot market volume to 44% since the start of the year. So it's very clear that investors are considering Bitcoin as sort of the ultimate safe haven, which is what you usually see during a crypto downturn. But sort of the pace of Bitcoin volume relative to all other crypto asset volume seems to be increasing. So I think that's a sign that, I guess, back to Bitcoin, like we typically see during these times of extreme volatility.
Right. Yeah. And I guess what do you see in terms of, the likelihood? I mean, obviously this is like the $1 million question, right? When do we get this spot ETF that actually goes through? I mean, David, I'll open it up to you as well. Like, what do you guys kind of see of the likelihood of this happening?
I mean, yeah, time frames. I've got no kind of insight into that. Although I have seen some stuff on like social media to suggest it's a little bit more imminent than what we're typically used to. So that would be interesting, and certainly, I don't know. Like I've always got that kind of spidey sense radar up. Like certainly there feels like something's afoot. It's certainly curious the timing with how quickly. We've had obviously BlackRock, and then we've had the talk about the Fidelity Grayscale thing coming out, Invesco today, sort of reigniting that application. So it feels to me like maybe something's going on, and I never think these things are too coincidental. And knowing the cost and the time that these things take as well, it just feels interesting. I've seen some suggestions that it's kind of, you can talk almost in weeks than in months or years. Who knows? I've got no insight, but I do think this is quite sort of significant. And actually, Joe, to pick you up on your earlier point, it does feel a little bit like January to me, and certainly the taker interest coming back that we're seeing. And also, if I kind of thought of where maybe some of the positioning was, and where some of the positioning pain would have been, obviously we've talked at length about some of this like ETH overwrites and what have you, and then kind of people jumping on that and that short vol move. The fact that we kind of again just focus back on Bitcoin, and that's kind of leading the charge. Yeah, it feels January, man. It really does.
Yeah. I mean, we'll see. I mean, we're kind of at the time of recording on this cusp of 29K and 30K. That is kind of like historically been kind of a difficult level to break. But I mean, shifting gears, Clara, I've really liked your guys's framework around examining crypto market liquidity. It's some of like, it's some of the best stuff out there. So. For our viewers, can you give like a quick summary of like what you're seeing right now? Liquidity being on the lows given the U.S. regulatory actions. Crypto on and off ramps being removed. Some market makers retreating from onshore exchanges. And on this podcast, we've talked about it before, where this low liquidity environment that we kind of have is kind of like a catalyst in itself, because the order book depth at here, I think I actually have a good chart from your research.
Oh, nice.
Right here, where the liquidity, the lack thereof, can almost be like a catalyst in itself, because it just doesn't take that much to move the market. So What do you think about that?
Yeah, so our liquidity, I guess first to define liquidity, we use order book data. So Kaiko collects 2 order book snapshots for nearly 200,000 traded instruments across 100 exchanges. So we have some of the most comprehensive order book data in the crypto data space. But of course, this data is massive and it's really hard to work with unless you're like a quant. So we build a really nice data set where we take market depth. It's essentially just the sum of all bids and all asks on either side of the mid price. And from that, at the instrument level, then you can build aggregations like total Bitcoin dollar depth across all exchanges, or total Bitcoin depth, where you take the sum of BTC USD, BTC USDT. So it sort of aggregates this immense amount of information, and it gives sort of a global measure for liquidity, which is what this chart shows. And actually, this chart aggregates not just Bitcoin, it aggregates the top 10 crypto assets. It's a new data type that we have that essentially lets you take the dollar value of liquidity for any combination of assets across every instrument in crypto markets. So this is a huge amount of data. And here we're looking at top 10 crypto asset, the change in the 1% market depth since the start of the year. And this is all exchanges. So we can see, it's dropped. We're down 20% as measured by market depth. We're really hit with a bunch of huge and bad events. We have the banking crisis, the cutoff from payment systems, and the regulatory crackdown, which has really scared market makers, because essentially what we're looking at is market maker activity.
Right. It looks like it's kind of, so I pulled this from your guys' Q2 liquidity report. Kind of seems like we've had a decent spike back, over the past, the past week or so. What's the driver of that? Is that kind of just, noise in the data, or was there kind of something that you attribute that move to?
That's a good question. I need to look at the exchange level information. I mean, overall, there's been a lot going on with Binance and Binance US. And so you'll have market makers sort of react to this negative news. They'll remove liquidity from the exchanges, and then when things settle down, they'll sort of re-add it. So we could be just seeing some noise in the data, but I'd have to look at the exchange level information.
Yeah, it makes sense. And look, I mean, we'll tell you from the paradigm perspective, we see the consequences of this extreme low liquidity environment, in the delta hedging from market makers. When they effectively need to rebalance their crypto options exposure. And, you really see it. When a big option print goes through, it really has the ability to move the market. And you're considering the small size of the crypto vol markets. I mean, I think, given the volumes have really kind of taken a hit in this range bound market, $1 billion a day is a really good day. And it's pretty interesting, this reflexivity of the crypto vol markets kind of due to this lack of liquidity. And when dealers need to rebalance their deltas, it really has the potential to move the markets. And I think it's absolutely no coincidence that as we get this move higher, we're seeing some big takers kind of come in and continue to buy more upside, and effectively just push dealers shorter gamma and shorter vol, which kind of pushes the market higher in itself in this sort of, reflexive feedback loop. Because as we've talked about on this podcast, there's just some taker balance sheets out there that just have the ability, to dwarf those of market makers. And it's kind of a nice change of pace from what we were discussing a couple weeks ago on the podcast, where we have seen this massive Ethereum overrider. And I know, Clara, I know you guys have kind of, touched upon it as well in some of your crypto vol research. But what we saw with all these big overwrites was the market kind of showing this tendency to pin on strikes where, dealers are along a lot of gamma and mute the spot moves kind of in both directions. So very, very interesting.
Clara, I was just going to ask, the two interesting points sort of you brought up in terms of what's impacted liquidity. Obviously, we've had the regulatory uncertainty, and then also just a pure access from banks. We've had a couple of big banks sort of go under in March. What kind of weight do you put on those two drivers of illiquidity in terms of which has been more important? Is it just a pure banking access and ability to service those fiat on-ramps, or is it the regulatory uncertainty, or can we not really measure that in any tangible way?
I would say you can measure banking access by looking sort of at the fiat trading pairs, assuming that people trading the fiat pairs are the ones that need the dollar off ramps, the dollar on and off ramps with 24/7 access. Whereas when you're looking sort of at the big offshore exchanges on Binance or the Tether and TUSD markets, where you're still relying on stable coins, and maybe you can settle the day in stable coins because you're less regulated. So you can sort of use that as a gauge. What's interesting is we compared this US exchange liquidity versus offshore liquidity, and we found that it's about the same. So the drop in market depth has been impacted both globally and in the US, which means that maybe it's not actually the payment channels that is causing this. It could be just sort of a global downturn in sort of sentiment in the crypto space and genuine fear about what's going on in the US on the regulatory front.
Yeah, interesting.
Right. And shifting gears away from the US, what did you make of the Tether depeg that we had last week?
Yeah, so we looked into that in our Monday newsletter. And we found that there was a lot of selling before Tether actually depegged. And by depeg, it was very minor. It was just a fraction of a cent, but still, that's a big deal for a stable coin that's supposed to be pegged to the dollar. We noticed that 3 days before, there was a huge increase in selling pressure on Binance and on a handful of other exchanges. We measured the quantity of sell versus buy orders, the CVD. And I think this is interesting because, like, who are these sellers? No one really knows. I was looking for on Twitter, sort of scouring all the news sources we normally have, and Tether even then published a press release saying it was a manipulation attempt. But who and why? Because the news that was dropped on Friday, which you would expect would have sort of a bearish impact, it didn't say that much different from what we've already seen these journalists reporting on when it comes to Tether's reserves.
Yeah, and look, would there ever be a significant crypto sell-off without a Tether depeg? And the Tether, I think it was the CEO came out on Twitter with some like pretty funny memes around that. But I think the timing of the depeg is pretty interesting, right? I mean, the SEC has gone after Coinbase, they've gone after Binance. I mean, I would think that Tether would kind of be a next natural target for them. So if you're a big holder of USDT, and I mean, there was a pretty decent depeg in the curve pools as well, right?
Mm-hmm.
Maybe you de-risk, sell some of your USDT and put it into USDC. Or maybe there's people out there that potentially know something.
There's always a Tether conspiracy. When has there ever not been? So, like, someone might know maybe a large entity just decided to cash out of crypto. The thing is, like, why would you sell Tether on spot markets if you are a whale when you can just redeem them, assuming you are a whale? And so that's what doesn't make sense is, like, because spot markets dipped and it dipped below $1, that means they got slippage, which means they weren't getting $1 for $1, unless the fees on Tether were higher than what they simulated for price slippage. Like, I'm not really sure how they did it, but...
Right. Yeah, that makes total sense. Yeah, and just kind of shifting gears back into, the vol markets here. It's pretty interesting to see. I mean, if you just look at these Bitcoin Ethereum spreads now, I remember when there were a lot of articles going on around, the internet when Ethereum was kind of priced at a, zero vol premium. Now we're talking about Ethereum at, an 8 vol discount to Bitcoin. And look, I think that makes sense, given the iShares, BlackRock sort of narrative at play. And if you look at the skew, right? So if you look at the BTC versus Ethereum 25 delta skew normalized for at the money, this actually tells a fairly interesting story here. So 25 delta skew is measuring the difference in the implied call, the implied vol of the calls versus the implied vol of the puts, but then it's standardized for the level of at the money vol. And if you see it in BTC, it's at the extreme. So, the calls are relatively expensive relative to the puts. And if you look at it in Ethereum, it's kind of like barely in the sort of upper percentile of the year-to-date range. And of course, a decent reason for that is, it's had less of a rally, over the past couple of days. And I think also another reason is we've kind of beaten the death at this point in this podcast is this, this overrider flow that's just drowning the market in vol is a big reason for this. There's a very large open interest position in the June 1800s. And I think that's part of the reason why we haven't been really able to break this level, right? So, vols are on the lows in both assets. So it's, to us, it's not really all that surprising, to see all this outright upside interest in BTC, but also in call spreads to kind of take advantage of this elevated call skew. And, I think it kind of makes sense, right? I mean, crypto majors barely reacted at all on the negative SEC news around Binance and Coinbase. And when spot shows a muted reaction to negative news and rallies strongly on positive news like the BlackRock news, that kind of tells me that, the paper hands at this point are potentially gone. And it's now just, long-term holders and people that are kind of just in accumulation mode. So David and Clara, what's your kind of like sense of positioning here? Like, are institutional investors like pretty damn like under positioned for a move if we were to go another leg higher? And what do you think is like the continued momentum that kind of takes us to that next level through 30K?
It's interesting you say that, because we just, in our analyst call last night, we did a chart looking at daily volume, sort of tagging the SEC lawsuits, which you would expect in any other market environment to have like a massive sell-off. It targeted the world's largest exchange, but you see only a tiny, tiny increase in trade volume on that day. And other than that, spot trade volumes are like at multi-year lows. So there was pretty much no reaction at all when looking at spot markets, much like how you're seeing sort of on the options front.
Right.
Yeah, I'd add to that. One of the things underpinning my bullishness for most of this year has been the fact that, I kind of felt the big deleveraging happened last year. There's not a huge amount of, long leverage in the system. You kind of left with the hodlers, because anyone that was probably going to stop out, they would have stopped out over the last year or so with everything that's gone on. So I kind of feel there's not the leverage in the system. Lows that are long are now hodlers, and they're not going to be puking out just over a few sort of scary headlines. And then you've been like battered by all this like constant negative headlines. So it's kind of like what's the catalyst for a big downside sell-off? It's just not there, which I think partly feeds this positive spot vol correlation that we've been seeing, right? Every time spot comes off, actually vol collapses because it becomes unexciting. So I definitely don't think there's a lot of positioning, and I actually think there's an asymmetric risk reward here in terms of the position that goes on will be to get long, because people, FOMO and will want to sort of get long. The other thing as well is, and I kind of think you've seen this in equities and certainly in NASDAQ, is often it's about how you manage your benchmarks. And one of the things I've been saying for a lot of this year, we come out the traps flying in January. And if you remember back in January, we're still kind of, working off the hangover a little bit, at least mentally and from a narrative perspective from December, which kind of felt like end of world type scenarios, right? Even though we'd stabilized. But then all of a sudden we come flying out the traps. We had a really quick move. And guys that I speak to, a lot of guys missed it. A lot of guys missed that move. And before you know it, Bitcoin's up 70% or what have you. So I think those that are benchmarked to Bitcoin, those funds benchmarked to Bitcoin, are massively underperforming their benchmark. So that underweight is going to force them to have to chase these moves. So they were probably hoping that we were going to sort of drift back down so that they could get back in. And all of a sudden we're seeing a quick move again. Now, if you're benchmarked to Bitcoin, you can't be that far behind your benchmark. And I think you're seeing that in NASDAQ and, full spying, because you have to kind of reweight towards your benchmark. Otherwise, you're going to watch that run away from you. So, yeah, I think the market is hugely underpositioned, and there's going to be a lot more chasing to come. So I actually think you ask what's going to kind of, maybe take us through some of these clearly, big resistance levels on the way up to 30K and certainly as we get towards the highs of the year. I just think false position chasing. We've probably got some shorts that'll get squeezed. There's a little bit of negative gamma still to probably run, and chasing's higher. But I think it will be those that have to just go, right, we have to throw the towel and chase this positioning higher because we're so far behind our benchmarks.
Yeah, I think that makes sense. But, that being said, David, I feel like so much of your argument around the bullish thesis of BTC has been around liquidity, right? And now we've had a Fed meeting, and now there's, one or two more rate hikes priced this year, which kind of, goes against that easy sort of liquidity thesis. So I guess what is your counter to that? Like, you've been pretty bearish over the past couple of months. Like, are you changing your tune here? And if you are changing your tune, I can't imagine it's due to the rate repricing.
Yeah, so I think a lot of what drove my bearishness over the last few weeks or so was in anticipation of this liquidity drain post the debt ceiling hike, and the Treasury rebuilding the TGA balance and that massive liquidity drain. So that was, and we're so tied to liquidity. So that was underpinning that bearishness. What we've actually seen is the RRP, the reserve repo, has been actually drawing down to offset some of that Treasury issuance. So the net liquidity impact's not been as big. And also the Treasury have been issuing T-bills. So Actually, sorry, I can hear myself back a little bit. I don't know if it's echoey to you guys.
No, I'm fine.
Okay, cool. Yeah, so the other thing as well is that the Treasury have been issuing T-bills, so that's easier to absorb, and actually, money market funds will flow into that. So we're not seeing the same liquidity drain or that we feared. Now that's still lurking in the background. So liquidity has actually ticked up and improved over the last couple of weeks. You started to see China come back to the market. There's talk of a 1 trillion yuan liquidity program or stimulus program. You still got the Bank of Japan buying. So actually, global liquidity has actually improved. And then the big offset as well, which actually helps liquidity, is the dollar's started to reverse lower as well. So if you think a few weeks ago, dollar was kind of going higher, US rates were going higher. The US rate's still a little bit peaky, but they've kind of looked like they've stabilized and maybe heading lower again. Dollar's come off substantially. So actually, liquidity conditions have got better. And we've not seen this big liquidity drain on the TGA. So I think we can kind of, and those headwinds are now kind of starting to turn into a tailwind. So global liquidity is actually picking up here, Joe.
Got it. And kind of just going back to Kaiko, a question I've had, kind of since, FTX and, the increasing concerns around counterparty risk on centralized exchanges, have you guys seen like more demand for, DeFi data? What are you seeing in the DeFi space? Are you guys seeing, more and more interest kind of going this way due to, the increased counterparty risk? Or would you say maybe there was like an initial pop and it's kind of tapered off a little bit?
I mean, I would say, honestly, there hasn't been much of a change in terms of the level of interest. I think DeFi, unfortunately, was sort of swept up in all of the FTX stuff. And especially when it came to sort of collateral and how these centralized lenders were sort of interacting with DeFi protocols, and there were a lot of losses. And at the end of the day, especially on the DeFi lending side, it's only a handful of people in crypto using them, but they're whales. So whales certainly use these DeFi lending protocols to take out loans for trading. But other than that, you're not seeing much retail usage at all. And even on the DEX side, it's still largely whale driven, especially decentralized exchanges like Curve, which are a very nice way to do a stablecoin swap. But other than that, it's not overly friendly for retail users today. So on the data side, though, I guess that was your question. Because Kaiko still is a B2B data provider, we do cater for these institutions. We're getting a lot of interest on the research front, specifically from traditional financial institutions on DeFi. But I still think there's quite a ways to go before there's this more global adoption.
On DeFi volumes actually up, and certainly since a lot of the banking issues and stuff. Is that a trend that we've seen?
So we saw a huge spike in stablecoin volumes during the banking crisis because there was the USDC depegging, and there was a USDT depegging last week. And the spike in volumes you see is mostly from the 3 pool on Curve. So yeah, volumes are up. It's not necessarily up because there's increased traders. It's because there's volatility in the markets and traders are reacting.
Yeah, that's interesting. The other sort of question that I had, obviously a lot of focus on Binance over recent weeks. In fact, always. But, they're not just in the US, actually in Europe as well. Sort of recent news in terms of pulling the FCA application and what have you. In a world where Binance dominance falls, where does that flow migrate to? And why have other exchanges, do you think, struggled to compete with Binance? Because it's still so dominant in this space.
Honestly, Binance's rise, they are so dominant. Even today, they're still greater than 50% of global trade volumes. Despite a wave of SEC and CFTC lawsuits, it's almost baffling to just understand its grasp on the world of crypto. In terms of other exchanges, I think that their closest competitors were based in APAC. You had OKX and Huobi, but each of those exchanges sort of made an error in focusing on APAC rather than going global, whereas Binance was we are a global exchange, we're not tied anywhere. And so OKX and Huobi, they're still some of the largest exchanges, but they lost a ton of market share as China banned crypto. And that was the grave error that they all made. Whereas Binance did not. And Binance sort of blossomed after that, to say And so I think it will be interesting to see, though, what happens as Binance gets regulated in the US. Also in the EU, they're now under investigation in France, which was supposed to be its big EU headquarters. And so where are they going to go? Are they going to lose all of their usage in the EU? They were just kicked out of GBP deposits. They just pulled out of the UK. They're pulling out of Australia. So it's like, where else do they go if it's both the US and EU?
And currently, are you seeing like any particular patterns in terms of that flow migration, or is it quite evenly dispersed across other exchanges? I mean, obviously we've actually seen that little tick.
Certainly the big narrative everyone's talking about is Hong Kong, opening up retail trading. Like, have you seen, I imagine it's probably a little bit too early, just given, they just opened up the ability, or I think there's two exchanges in Hong Kong that are approved allowing retail trading. But like, are you starting to see a little bit more of a migration there? And maybe those exchanges that were really focused on APAC kind of, since that's where their DNA is, kind of use this as an opportunity to, really get the head start there. I mean, what do you think on that?
Yeah, I mean, it's really hard to measure this stuff just because centralized exchanges are often global, and it's like the data's anonymous. You don't know who's executing the trades. So what we do typically is, as a proxy, is we'll look at like time of day and the hourly volumes, whether it's APAC hours versus US hours, or we'll look at the fiat denominated currency, like USD currency pairs versus like Tether currency pairs. We actually did see a slight migration towards APAC right after the first Binance CFTC lawsuit, but overall volumes are way lower. So there's like nuance between market share and trade volume. Like Binance's volumes have not held up as strong as other exchanges, but everything's still down globally.
In terms of, I think it was you guys that put out like a pretty good chart on, time of day volumes really migrating from, US hours into Asia hours. What are like the key hours of trading, of in the spot markets in crypto?
So the peak hour is at the exact overlap between US and EU. You have like one spike. I think it's like 8 a.m. EST or 9 a.m. EST. And it's where EU traders are still online. US traders are just waking up. Then you have like sort of 2 hours there where it's still really high, and then it sort of dips. And then you have a slight spike at APAC like morning, but it's still lower than what you see US EU.
Just one other question I had, I thought was potentially quite interesting. Obviously, there's still lots of de-dollarization stories going about, which we've kind of debunked on this show before. I don't believe in that story particularly, but yeah, perhaps there's a slow move to moving away from the dollar, particularly as it relates to crypto, and given the US approach and aggressiveness towards crypto at the moment. Are you seeing any kind of move away from sort of dollar stable coins and dollar pairs? Because dollar-based stable coins is still dominant in crypto.
Yeah.
Are we seeing a migration away from that at all?
Oh, dollar stable coins, they're always, I think, well, at least for the near future, there's no migration away. There's a euro stablecoin, but it has like virtually no volumes. Part of the reason I think that is that there were like zero interest rates in Europe for years, and so like the business model didn't really make sense for stablecoin issuers to do like a euro stablecoin. What we did see that was interesting was dollar versus euro denominated crypto volume on exchanges. We have seen a doubling in euro volume from 10% to 20% relative to the dollar since last year. So it's still small. It's just 20% of dollar denominated volumes. And I'm pretty sure it's just Kraken that's sort of leading this increase. Kraken has sort of weathered a lot of the market volatility over the past few months. Their liquidity is still pretty stable, and they're very popular in the EU. So I think that's probably linked to Kraken, but it is interesting nonetheless.
Okay, awesome. I think we're running out of time here, but Clara, thank you so much for coming on. This was extremely insightful, and to our viewers, we will link some of their research in the description below. Definitely check it out. Definitely subscribe. Some of the best stuff out there. So Clara, thank you so much for coming on.